So good evening, everyone. Thanks for joining us today for our webinar as we all get ready for the upcoming rate hikes. I'm Sarah Chia from the Bond Supermart team, and I'll be your host and moderator for the night. So as we prepared for tonight's webinar, the team and I, we also look back at the work we've done over the past year and the views that we've put out. And one thing that really stood out was how, just 6 months ago at a webinar, we were already fretting about inflation. The environment is a little different today, with the Fed looking to raise rates. You have some reports saying that we have 3 rate hikes this year. You have some market participants saying we have 4. And you also have Jamie Dimon, who's looking at 6 to 7 this year. Well, the Fed has also reduced their balance sheet, and they are also accelerating their asset tapering efforts. And so now the big question for everyone is, how do we prepare for that? And what are the opportunities out there that will better bolster my portfolio? So before I introduce our speakers for the night, if you haven't already, please download a copy of our first half 2022 Bond Picks report. You can go to the links here or the QR code or scan the QR code here. In this round's report, we've categorized our best picks according to sectors like banks, Asian high yield, ESG, USD, and SGD issuers. Hopefully this makes it much easier for you to select bonds and ultimately help you find one or a few that suits your needs. In this issue, we've also identified 26 issuers and 31 bonds that we're positive on. Inside our report, you'll also be able to read our market outlook and commentary about each and every issuer that we're keen on. So let us know what you think. You can always contact us via Facebook. Just look for us at Bond Supermart, and you can just easily share your thoughts there with us. Okay, and now let me introduce our panel of speakers. So first we have Jackson Chan. He's our Assistant Manager of Fixed Income Research at IFAS Hong Kong. His main focus is on studying Asian high-yield credits, especially Chinese real estate and casino sectors. So if you are a frequent viewer of our Bond Smart website, you'll actually notice that a lot of the Chinese real estate articles are fronted by him, are written by him. Jason Si is a fixed income analyst at IFAS Hong Kong, focused on Asian credits. So prior to joining us, Jason was with a Swiss-based family office doing investment research on global equities, credits, and funds. Next, we have Dexter Tan. He is a senior fixed income analyst with IFAS Singapore. Dexter was previously with NUS Risk Management Institute as a credit research associate, and he focused on researching distressed issuers and corporate default situations. He was also at Eureka Hedge and Phillips Securities, and he currently holds a master's in statistics from the National University of Singapore. Last but not least, we also have Lim Ting Chong with us today. He's a fixed income analyst with a research team at IFAS Singapore, specializing in Sing dollar bonds. And now let's move on to tonight's agenda. So we have it split up into 3 segments. In our first segment, we have Dexter. He'll take you through our Bond Picks report and share with you how we're going to get ready for the upcoming rate hikes. And then we'll address the biggest concerns that investors have. Some of you have already sent us your questions, and our analysts have prepared for them and will be answering them. They'll be addressing questions like whether high rates are good or bad for the fixed income space. We'll be addressing questions on our outlook on the economy and what all of this really means for investors. After that, we'll transition to our third segment where we'll hold our live Q&A. So we would love to hear all of your questions. So please send in your queries into the Q&A box below, and our analysts will address them towards the end of their segment. So for our first segment today, we'll have Dexter Tan, our senior fixed income analyst, to share his thoughts with us on how we can get ready for the upcoming rate hikes. So Dexter, over to you, please.
Yeah, thanks, Sarah. So I'll be addressing the rate hikes, the upcoming rate hikes. Next slide, please. Over the past 2 years, central banks have kept a accommodative monetary policy because of COVID-19. Central banks have taken aggressive action to cut interest rates. At the beginning of 2020, the US Federal Reserve reduced the Fed funds target rate as shown in the dotted line here from 1.75% to 0.25%. And since then, the Fed target rate was kept at 0.25% since the early 2020. Now, the Reserve Bank of Australia, which is Australia's central bank, followed the Federal Reserve and cut interest rates from 0.75% to 0.1%. And this is shown in the gray line. Now, perhaps the most dovish of the major central banks is the ECB, or European Central Bank, and they have kept benchmark rates on hold throughout the pandemic. So this is the light blue line along the axis. And in fact, last year, in October, the ECB said that they will not be considering rate hikes this year. So what is perhaps different from the other central banks is the Bank of England and the Reserve Bank of New Zealand. And they actually raised interest rates last year. So this is the black line is the official cash rate by the Reserve Bank of New Zealand. And they were actually late in cutting interest rates at the onset of the pandemic, which is the early 2020s. But however, they were actually the first, one of the first major central banks to raise interest rates last year. So if we just follow the black line, you can tell that it's gone from 0.25% to 0.5% in October, and then it went up further to about 0.75% in November. Now, the situation in New Zealand is that housing prices were surging and the property market was quite overheated, and which is why the policymakers decided to actually take action and raise interest rates. Now, for the Bank of England, they raised the official bank rate last year also, and the increase, even though it's quite small, so you can tell it's actually gone from 0.1% to 0.25%. So this is just 15 percentage points, but overall, it still signals that the Bank of England is still hawkish. Now, next slide. So looking at emerging markets like Malaysia, Indonesia, and Thailand, so these central banks are somewhat different from the earlier ones. So they're actually quite dovish, as you can tell from the blue dotted and gray line. So the blue line is actually the 7-day reverse repo rate from Bank Indonesia. And then, so in Indonesia, there was a surge in COVID-19 cases, and the country actually implemented travel restrictions to curb the spread of the virus, thereby affecting low economic activity. So Indonesia kept interest rates low to actually encourage credit lending within the country. And then we have Malaysia, who has cut the overnight policy rate from 2.75% to 1.75%. So Bank Negara said that they would like to wait for stronger growth before raising benchmark rates. So Thailand, on the other hand, was affected by the drop in tourist arrivals, and they cut their repurchase 1-day rate from 1.25 to about 0.5%. So the reason for the low interest rates in Thailand is that because many households and business financial stability is still an issue to the central bank, and which is why, and there's actually some high level of corporate debt as well as household debt within the country. Okay, next slide. So even though if you look at it, I think most interest rates are still low, at this point, but the outlook, which is the outlook, the forward-looking outlook, which is the rates, is actually to the upside. This is because if you look at consumer prices, they're actually increasing at a faster than normal rate in many economies, with inflation close to multi-year highs. So for example, here on the left, we have the global Bloomberg weighted CPI, which has increased to close to 6%, meaning prices are actually 6% higher this year compared to last year. So inflation in other countries like the US, UK, and Singapore has also seen a sharp rise in inflation. So I think all of us know this morning the MAS has made an announcement to actually tighten monetary policy because of inflation, and a lot of other factors have been widely discussed. I'm sure some of you have read about it. supply chain disruptions, and then there's this underinvestment in oil and gas because of ESG concerns. And then we suddenly, in the fourth quarter and the first quarter of this year, we have a surge in demand because people were traveling more. The cases have dropped, and then this Omicron variant is somewhat less deadly, and then we had somewhat higher retail spending. And as a result, one of the underlying drivers for inflation is also food prices because of, and this is largely because of unusual weather patterns. Next slide. So besides CPI or inflation, central banks are also keen to keep an eye on the job market, which has been improving. Here we see a picture of unemployment across different countries. Unemployment rate in many countries have turned around. So in fact, they are moving. If you look at the recent couple of months, they are moving towards their pre-COVID levels after they have risen quite sharply in 2020. So for example, in the US, the unemployment rate has grown to about 13% in 2020, but has decreased to about 4.2% as of most recently. So the Federal Reserve themselves are actually expecting a stronger job market this year. In fact, if you look at their forecast, they're actually expecting a better job market this year. During the pandemic, a lot of the jobs that were lost were actually from the hospitality and airline industry. So many people, like I said, they were traveling, and as a relaxation of the social distancing measures, there was greater demand, and which is why we are seeing more hiring within the sectors that have dropped off, which is the hospitality and airlines, as well as the food and beverage sectors. So likewise, I think this trend is quite apparent in many other countries. So I've shown them here, which is also showing a similar trend whereby unemployment rate is falling. So for example, in Singapore, the unemployment rate was at 3.5% in 2020, but it's dropped to about 2.6% in the third quarter of 2021. Next slide. So the Fed is actually expected to increase interest rates. And one interesting fact is that they're actually going to reduce their balance sheet. So that was the guidance more recently. The Fed indicated that they will conduct 3 rate hikes. And then if you look at the recent December meeting, the median Fed funds projection was about 0.9% for 2022 and about 1.6% for 2023. So this is an upward move from 0.3% and 1% at the September meeting. So in the latest minutes, the Fed actually, one thing was interesting was that they discussed the possibility of not reinvesting their maturing treasury securities, and as well as their agency mortgage-backed securities. So what this means is that they will allow the treasury securities to mature. And previously, they used to roll over these principal amounts, but now they are actually discussing not to roll over. So in other words, they are shrinking their balance sheet. So not only we are going to see higher interest rates, we also possibly could see a smaller balance sheet. So of course, the process of balance sheet normalization may affect the market, but the Fed thinks that the central bank is in a better position now to handle it, which is why it'll be quite interesting to see that. Next slide. So perhaps one of the more pressing questions that it comes to investors' minds is that how do bonds behave during an interest rate hike cycle? So, or more specifically, how did bonds behave during the past interest rate hike cycle? So I think if you read the news, in like a lot of people are comparing now to like 1970s. So in 1970s, we have very high inflation, and that was in the United States. So the inflation during the 1970s was blamed on like surging oil prices, currency speculators, and the US was also having a budget deficit. So in 1971, President Nixon actually removed the link to go and actually turn the American dollar into a fiat currency. So as a result, the dollar was devalued and interest rates were kept low, and thereby creating rapid inflation. So Paul Volcker, I think some of you have heard of him, the chairman of the Federal Reserve then, hiked interest rates to as high as 20%. So you can tell it from this red line seen here. So it's 20%, and it's a very high level. So between 1976 and 1980, the Fed raised interest rates to 20%, and commodities actually doubled during this period. 10-year Treasury yields went to 12.6%. So right now it's just 1 to 2%, but in the 1970s it went to 12.6%. So obviously, government bonds, which are inversely related to Treasury yields, fell during this period. So another interesting point to see is that the Fed target rate actually exceeded the 10-year Treasury yield at some point in 1978. So which is very rare to see, is because the Fed target rate is usually an overnight rate, but 10 years Treasury yields are actually 10 years interest rates in 10 years ahead. So the overnight rate actually exceeded the 10-year rate, which is quite interesting. But the point I'm trying to make is that in spite of very dramatic increase in interest rates, the S&P still ended the 4 years with a gain. So if you look at the gray line, it's actually 103, meaning that it's actually 3% higher than where it was in 1976. So the rate hike started from 4.75%, and then it increased to 20%, but the S&P 500 still ended up positive in spite of the interest rate hikes. Next slide. So now we move on to the 1990s. So in the 1990s, we also had some interest rate hike cycles. This time we have information on US high yield bonds and investment grade bonds, and which is why I included them in this diagram. So the high yield bonds are actually the dotted lines, and then the investment grade is the blue line, the darker blue line. So the Fed in the left, the Fed funds target rate was raised from 3.25% to 5.75%. So this was during the 1994 to 1995. So in 1994, the US economy was emerging from a big recession, and Alan Greenspan, the Fed chairman at that point, he surprised the markets by tightening monetary policy. So looking at the performance of different assets, the S&P still gave a healthy return. And what is more interesting is that US high yield bonds and investment grade bonds also made positive returns. As you can tell, they started at 100, but now they are more than 100. So similarly, and on the chart on the right, when the Fed, so this is another period, which is 1999 to about 2000. So the Fed target rate was raised from 4.75% to about 6%. So this is the technology bubble. It was a volatile period for stocks, as you can tell for the gray line. The S&P 500 was actually moving about back and forth about 5%. But so high yield bonds and investment grade bonds ended the period lower. So this was during the tech bubble. But what is interesting is that even though it's lower, the high yield bonds and investment grade bonds are actually just less than 5% lower. So that's a good, interesting point to make. So next slide, please. So more recently, we have seen interest rate hikes so this is from 2004 to 2006. This one is quite dramatic because the Fed raised interest rates from 1% to about 5.25%. So this 17 times straight increase in interest rates. So so the Fed increased interest rates almost every single meeting. So during this period, economic growth was slowing. Policymakers said that inflation expectations need to be contained. And in fact, if you look at high yield bonds and investment grade bonds, they still posted net positive returns during this period. So when Fed Chairman Janet Yellen took over in she also raised interest rates in 2015. So if looking at the chart on the right, the Fed funds rate was raised from 0.25% to about 2.5%. So this was during 2018, and labor market conditions were quite strong. Inflation was near the committee's 2% objective. And in both of these instances, if you look at the blue lines as well as the darker blue lines and the lighter blue lines, these are the high yield bonds and the investment grade bonds. So they actually gave investors positive returns in spite of rising interest rates. So what is the point I'm trying to make is that corporate bonds can actually give investors healthy returns in a tightening monetary policy environment. Interest rate hikes are actually a signal that economic growth is on a more sustainable path moving forward. So the labor market is actually strengthening, and tighter monetary policy is required to tame inflationary pressures. Okay, next slide. So now we have launched our bond picks report. So the report actually contains our ideas for 2022. So looking at the first half of 2022, we see value within the Asian high yield sector. Investors should be looking for opportunities within the borderline to investment grade segments. Secondly, another highlight is that the bank capital and the capital securities should do well given the high interest rate outlook. And then more recently, we have the conclusion of COP26. And with that, we see more financing opportunities for ESG bonds, as well as for investors. Next slide. So here's the list of bonds for your consideration. I mean, the bond picks here are, we also like a lot of names outside this list. So feel free to look at the report and look at these 31 bond picks that's come from 26 issuers. So for more details, you can actually read the report to find out more about the company profiles and the recent financial performance. So with that, I'll pass the time now to Sarah.
Okay, thank you, Dexter. So really appreciate the insights. And now, we're going to move into our second segment where we address the questions that you post to us over social media before our webinar. Well, for our first question, we had a bond investor who wanted to know, with all these upcoming or potential rate hikes, whether these higher impending rates are really good or bad for the fixed income space. And so for this, I'd like to invite Jackson and Dexter to share their thoughts. So Jackson first, please.
Okay, yeah, thank you, Sarah. Yeah, so generally, if market expects the interest rate to rise, the short-term treasury yield, let's say the 1 to 2 years treasury, the yield will rise accordingly because it is highly related to the interest rate. And that's why we saw that the yield curve has significantly flattened over the last 6 months, meaning that the short-term bond yields are almost equivalent to the yields of the long-term bonds. So in this case, because the inverted yield curve is not very common and not usually appears at the beginning of a rate hike cycle, so yeah, it is likely that the long-term bond yield will face some kind of upward pressure as well. So therefore, we believe that at this point, it is not the best time for investing into long-term investment grade bonds unless investors want to hold them to maturity. So on the other hand, because the high yield bonds usually have a shorter duration and also lower sensitivity to interest rates, we believe that they are able to outperform this year. Next slide, please. So narrowing down to the specifics, we believe that there is some industry that we can keep an eye on, and actually some sector. So the first one is actually the Asian high yield sector. Next slide. So to begin with, let's take a look into the global high yield bond spread first. So since June last year, the Asian high yield has suffered a big loss, and now it is significantly much more attractive than the US and European high yield bonds. So over the same period since last June, the Asian high yield spread has once widened for over 700 pips. So emerging market, which also includes China inside, but the yield spread has only widened around 150 pips. So on the other hand, the European and the American high yield market remain quite stable. Over the same period, they only have the spread widened by around 50 pips. Next slide. So I think many of you have heard that the Chinese real estate sector is in a crisis now. And we saw that many developers are facing debt troubles in the market and they are not able to refinance. So as a result, the market obviously has fear on it, and the Chinese real estate USD bond yield has skyrocketed. So here is our tracked bond yield index for the Chinese real estate bonds. So as you can see, there are two different lines. So we classify them into single B graded or double B graded bonds. And you can see that actually the average yield of the single B rated issuers has already exceeded 60%. And the average yield for the double B rated issuers is around 20%. Next slide, please. So with this extremely high yield, and also it has already demonstrated that the fundamental factors of the sector are severely impaired, and also the government is likely to start taking action from at this point, and we believe that it will be likely to happen like the 2013 to 2015 cycle. So we believe that because in the 2013 and 2015 cycle, the Chinese real estate sector is also at a very hard time, and we saw that both the residential sales amount and also the housing price is declining and at a very quick pace, and therefore the government has stepped up and tried to protect the market. And for this time, we also think that the government may make some possible move including, for example, speeding up the mortgage approval and also lowering the MLF and also the loan prime rate. On the other hand, they can also allow developers to refinance through the interbank channels. And there are some news, also rumors saying that the government is trying to loosen the regulation on the use of the pre-sales cash proceeds. So, but still, we have to admit that there are still more default cases to come in this sector, and we expect the sector sales to bottom. But on the other hand, we also expect the sector sales to bottom out very soon. So at this point, we believe that investors should keep a look for some sudden but short-lived opportunity that may arise for bonds with double B rated or above, or even investment grade bonds. So, but still, investors should be prepared to embrace the price volatility, and it is possible that a company bond can drop by around 10 to 20% just based on a single news that is in the market. So yeah, the market is very volatile right now. So investors have to be mentally prepared. So yeah, that's all for this part. So Hector, do you have anything you want to share on the industry selection?
Yeah, thanks, Jackson. Yeah, one of the industries that I like is banks. And the reason it's simple is because banks are able to attract deposits from savers and lend them out at higher margins to other their customers. And what the difference between the lending rate and the deposit rate is basically the net margin. So banks may attract more funding in the form of deposits and issue these loans to other companies at a higher rate. So this will help to boost their net profit. So higher interest rates could boost interest-related incomes of lenders, which will strengthen the capital positions of banks and increase their repayment ability of their AT1 instruments. Next slide. So for those of us who do not know, AT1s or additional Tier 1 bank instruments are a type of perpetual debt that the banks use to improve their core equity base. So these instruments are used to satisfy Basel banking requirements, and so they are also referred to as CoCos, and they rank just above shareholders in terms of their claims on assets. So the word CoCos means contingent convertibles, whereby they may be converted to shares in certain in certain circumstances. So they pay a high coupon rate to investors, and the performance of the instruments is shown here in the black line. As you can tell, during the last rate hike cycle between 2015 and 2019, AT1 bonds also registered gains on a total return basis. So this is, of course, referring to a portfolio of AT1 bonds. Next slide, please. Now we look at the different financials of banks within different geographies. Here we have the net interest incomes of different banks in different countries. So on the left, we have the large European banks. Then in the center, we have Singapore banks, and on the right, we have Chinese banks. You can tell that Chinese banks have particularly high net interest incomes because of their higher loan prime rates. In fact, the 1 year loan prime rate for Chinese banks is about, the 1 year loan prime rate in China is about 3.7%, and 5-year loan prime rate is about 4.6%. So net interest margins for Singapore banks are somewhat lower, below 2%, and borrowing rates in Europe are also much lower. Next slide. So for non-net interest incomes, because of the low rate environment, banks have been trying to rely on their non-net interest income to boost their overall profit. So this may come in the form of trading of debt and issuance of equity. As you can tell, non-net interest income is very lumpy and very unpredictable, and to a certain extent dependent on capital markets. Next slide. So here we are looking at total income. So total incomes has been improving, I would say, overall, and it's very much dependent on net interest income. So there's two components, non-interest income and net interest income. So I would say at the absolute level, total income is still quite decent for European banks and even for Singapore banks, with between 2.5 billion to 3 billion of total income. Next slide. So one thing about banks is that loan loss provisions is also a determinant of the bank's net profit. So when you see here on this chart that loan provisions are actually falling, meaning that banks have higher net profits in general, it signifies that the management is actually positive on economic prospects because they think that there will be general improvements in their loan quality. So we are seeing the fact that we're seeing lower loss provisions is actually positive for bank equity. Next slide. So another factor that we look at is non-performing loans. So non-performing loans has been falling, especially in Europe, and it's quite stable in Singapore. I would say it's also rather stable in China as well. In Europe, the banks can actually access the ECB's funding channels to boost their capital, and they've launched stimulus programs to help different companies to cope with the pandemic, and that was also a factor in pushing down these NPL or non-performing loan ratios. Next slide. So banks have kept a strong capital position due to their Basel capital requirements. So here we have CET1 ratios. So it's actually measuring a proportion of high quality regulatory capital as a ratio of their risk-weighted assets. So it's a measure of their capital strength of the bank. So if you see it's increasing, meaning that the bank's capital position is actually improving, and this is good for bondholders as well as the AT1 perpetual note holders. So with that, I would like to pass on to Sarah, who will take us to the next segment.
Thank you, Dexter and Jackson. So I believe just now we saw a question. I think one of our listeners or viewers had a question about high yield, Asian high yield bonds. So hopefully Jackson's sharing just now was able to help you get more clarity on the current situation. So now moving on to our second question. So we had a number of investors who reached out to us about the rising interest rates in the US. The Fed's decision to raise rates were generally seen as hawkish, which meant that the Fed is favoring higher interest rates to keep inflation in check. Implicitly, it can also be interpreted that the Fed is confident of the US economic recovery ahead, which warrants the monetary tightening. Yet, while markets have generally accepted and anticipated the rate hikes, so just now I think we mentioned potentially 3 to 4 times this year, or if you're Jamie Dimon, then perhaps 6 or 7. It's still up in the air whether the hikes will actually materialize into reality. Much would be predicated on the pace of recovery in the US economy, as well as the global economy improving, which is currently complicated by the surge in Omicron cases around the world. And so for our investors, I'm sure you guys are interested, to know whether our research analysts agree with that and what is their outlook on the economy. So now we pass our time on to our analysts, Teng Chong and Jason, for them to share their views on this topic. So Teng Chong?
Yep, thanks, Sarah. So global economic recovery depends on the speed in which we all return back to normal. With more countries opening its borders, it will definitely help with global economic recovery. However, inflation remains to be a persistent issue in the US and globally as well. Not forgetting to mention, new variants will continue to dampen economic recovery as countries may impose lockdowns or restrictive measures to combat the spread of new variants. So as previously mentioned, the Fed has signaled that they will start to accelerate tapering of its bond buying program, and also the program is expected to end in March of this year. And as well, at the same time, interest rates are also expected to increase by 3 to 4 rate hikes in 2022. So looking ahead, I think there's little doubt that the US is likely to start their rate hike cycle this year. But I think the grand question is by how much will the Fed increase its rates and by how many rate hikes. So the Fed has signaled 3 to 4 rate hikes, but Wall Street is building expectations that more rate hikes could occur. So as mentioned previously as well, the CEO of JP Morgan, Jamie Dimon, during his fourth quarter earnings call, have said that he is expecting up to 7 rate hikes this year. So now looking at economic data, US unemployment rate is improving, but inflation still remains at high levels. Cost pressures are also a headwind for US's recovery. And according to the National Association for Business Economics Business Conditions Survey, the number of companies reporting higher wages and material costs are at near historical peak levels. And this is a clear indication of mounting cost pressures. So therefore, we expect US's economic growth to slow down in 2022 due to rising inflation, which will slow down consumer spending, and as well as rising cost pressures in the US. Next slide, please. Now moving on to other markets, Europe could be a more attractive market to play the global economic recovery than the US. This is due to its more globalized revenue exposure and pro-cyclical tilt, and relatively more dovish policies. Europe has been hit with the fifth wave of COVID-19, which is led by the Omicron variant. Case counts are peaking, and particularly in major economies like Germany, France, and the UK. However, we think that Europe's combination of high vaccination rates and decisive policy making can help tide Europe through this fifth wave of COVID-19. Inflation in Europe has recently surged to record highs, so 4.9% year on year in November 2021. And ECB has also recently revised their official inflation projection upwards. So it's 3.2% in 2022 and 1.8% in 2023. And ECB's Lagarde has taken a more conservative stance on inflation as compared to the Fed, and they remain relatively cautious on growth. So now, with this more conservative take towards growth, ECB's Lagarde has pledged to keep policy loose thus far. And therefore, with more dovish policies, we think that EU's markets are more attractive than the US. Next slide. Now, going back locally in Singapore, Singapore's economic growth for 2021 is expected to come in at 7.2%, according to advanced estimates from MTI. The growth in Singapore was driven by the manufacturing sector. Singapore's economic recovery and growth is dependent on the improvement in supply chain shortages, as Dexter mentioned, and which could result in a smoother flow of labor and raw materials into Singapore, leading to a resumption in construction activity. And we feel that reopening plans will support the services sector, especially transport and retail. And additionally, just in today, MAS tightened monetary policy by increasing the slope of the Singapore dollar nominal effective exchange rate policy band in an attempt to push down inflation in Singapore. And now on the whole, we believe that Singapore's economic growth will moderate in 2022. And according to consensus estimates, GDP growth is likely to normalize to 4% in 2022. And the official forecast by MTI is in the range of 3 to 5%. Now I'll pass it on to Jason, who will speak on China and emerging markets.
Thank you, Teng Chong. So I will go through the China outlook. So for China, apart from the inflation concern, the Chinese real estate sector and the regulations in the technology sector and also our real estate sector would be the key factors that the market is focusing on. So we do see around 5% GDP growth for our forecast for China economy, given that it has a strong consumption and investment growth, as well as the potential policy loosening in both real estate and also internet sectors. Right now, China still retains its zero tolerance approach towards COVID-19 pandemic. However, the higher saving rates and also the recent restrictions should result in some net payment up demand for the retail sales and consumptions. And besides, the real estate and the infrastructure investment are still robust. For the real estate part, we do see, as Jackson mentioned, we do see the speed of approving mortgage is accelerating, and also the mortgage rates are going down, which should drive the demand for real estate. On the other hand, the infrastructure investment, we see positive growth since there are increasing special debt quotas that should boost the investment in this area. We see that in the first quarter of 2022. So overall, the fixed asset investment, including the infrastructure real estate, are expected to grow more than 6%. On the other hand, China has more room for more monetary policy, given that they recovered quicker from the pandemic and also was able to engage in some policy normalization last year. The PBOC has already loosened its policies, for example, lowering the MLF 1-year leading rate, as well as cutting the bank's required reserve rate recently. So the liquidity and also the credit indicators has been improved. For the fiscal policy side, it is expected to remain slightly expansionary, given the favorable policies towards the digital economy, as well as alternative energies, as well as more budgets on infrastructure, transportation, and logistics. Next slide, please. So for emerging markets, we see that many emerging countries actually have seen a surge in vaccination rates, and also as well as COVID-19 cases have gradually subsided. A wave of reopening international traffic to stimulate the macro data as well as the regional risk appetite. Although we are worried about the reopening delays, especially for those countries who have less people get vaccinated. On the other hand, the rising commodity prices actually provide a favorable business environment for most emerging market countries. However, we do note that the credit growth is seeing a signs of slowing, particularly with the Fed tightening policies, with multiple rate hikes and also potential balance sheet runoff, as Teng Chong mentioned. The periods of credit tightening has historically associated with the weaknesses in the industry metal prices in particular. We do think that there may be some divergence in the performance of different commodities, which may likely affect the emerging market differently. We also think that some people may concern on the inflation risk for the emerging market as well. In fact, the mix of rising energy and also the food prices, as well as the weakening currencies, and also the supply disruption have resulted in surge in inflation rate in these emerging markets. For example, Russia, Brazil. So they will also have the rate high to control the inflation. So we believe that the inflation risk remain high in the near term. So here is my sharing. So I pass the time to Sarah again.
Thank you, Jason, and thank you, Ting Chong. So amidst all that is happening, well, the biggest question that investors have now is, what on earth does this mean for investors? I think you would have gotten a number of clues from our analysts here from their earlier sharings, but I'll just have Jackson sum it all up for us.
Okay, so here I will just tell you what Ting Chong and Jason sharing on the macroeconomic should have the changes on your portfolio. So I think that it is important to make changes to your portfolio. So as we should understand that the bonds that have longest maturity dates and also the lowest coupons are the most sensitive to the interest rate changes. So here's the example here. The bond issued by Apple. You may all know that it should be considered very safe. So yeah, its S&P rating is around AA+, so which is almost close to the prime rate. However, we saw that when the treasury yields go up, this bond price has actually dropped by over $10 in just 6 months. So for investors actually who are holding this Apple bonds, they have to suffer quite a big loss. So given this kind of example, we should understand that it is still not the best timing to invest into the long-term investment grade bonds because we still think that the long-term treasury yield bond, the yield will go up, and therefore this kind of bond may still suffer and may still have the price dropping over the next year, over this 2022. So we think that maybe given that the rate hike cycle started, and maybe after 2 to 3 rate hike, we think the long-term bond yield, the treasury yield, will remain will be more stable and maybe over 2%. And at that point, we think that it is the correct timing for investors to get into the market. But at this point, we think that for investors who are still holding some kind of a long-term investment grade bond, yeah. So unless you actually want to hold until maturity, otherwise maybe you can make changes by adding some kind of higher bonds or some kind of a lower duration bond in your portfolio to avoid the price decline. Yeah. So next up,
Thanks. So I also saw a question in our Q&A. Someone was asking, what kind of bonds should we be looking at in such an environment? And I hope that Jackson's sort of recap there was able to give you some insight as to what you can look at. Okay, so moving up, next, our analysts have also prepared a bond pick each. I'll let Jackson take the lead here.
Okay, yeah. So maybe I will share our bond pick for this year. So the first one of our bond picks are actually Hobson Development. So yeah, this Hobson Development is a Chinese developer, and we believe this company is maybe able to get a breakthrough in the recent sector downturn and also the industry reshuffle, and also return to its former glory. So here's the reason why we support this company and its credit. So first of all, Hobson Development has a relatively smaller sales amount, so it allows the company to outperform the growth rate of its peers. So over 2021 last year, although that the sector is not in a very good shape, but Hobson Development is still able to maintain around 20% sales growth rate. So which is pretty impressive. So on the other hand, Hoxton Development is also able to maintain a quite resilient cash flow because it has very superior pricing power and sales flexibility during the sector downturn. And also the group's enormous land bank, which translates to around 25 times land bank to sales ratio, could absolutely give a promising outlook for its future business. On the other hand, the credit indicators also look quite decent for the group, so we assess the on and off balance sheet operating and credit indicators. So and here you can see that some kind of a normal indicator that we'll look at, including the free red lines, the cash on hand, and also the average borrowing cost. And Hoxton Development has actually improving its credit in June of last year. So and on the other hand, we also assess its off balance sheet credit indicators, and we find that Hoxton Development is pretty good we think that it does not hide a lot of debt off their balance sheet. So and last but not least, since August last year, the group has already spent around 530 million Hong Kong dollars to perform 28 share buybacks. So we think that it also shows that the management has the confidence in their current cash flow. Next slide, please. At this point, the Hoxton Development bond due in 2023 December has a yield to maturity of around 9.4%. So we saw that this yield is much lower than the average of the B-rated peers. So the reason why is just because the Hoxton Development obviously has a credit profile superior to most of its peers, and we think that it is even better than some of the BB rated peers. So at this point, although Hoxton Development credit rating is is single B by S&P and B+ by Fitch, however, we think that its credit profile is actually better than this rating, and you can see the market also feel the same because the Hoxton Development bond price is much steadier compared to its fellow developers. So yeah, this one is currently available on Bond Express, and it offers around 9.7% yield. So we think it is quite attractive. Yeah, so that's my bond pick, and I will let Dexter to share his bond pick.
Yeah, thank you, Jackson. There are many bonds that I like within the bond universe, but if you just ask me to pick one, it's a difficult question, but I would say maybe the SocGen 6.125 perpetual note issued by Société Générale, which is the 6th largest bank in Europe and the 18th largest worldwide when ranked by total assets. So earlier, I highlighted the case for bank instruments, and that's because of higher interest rates, greater net interest margins, and that would help their total incomes. And if we look at loan loss provisions, it's also falling, improving asset quality, and then looking at their capital adequacy ratio, so it's also pretty healthy. So SocGen is rated by the three major rating agencies, S&P A, which is high investment grade with a stable outlook, A1 by Moody's with a stable outlook, and Fitch Ratings A- with a stable outlook. Now, SocGen also has a diversified business model with a strong franchise in key activities. It also runs a profitable retail banking unit in Central and Eastern Europe, thereby giving exposure to that part of the world. So its consumer unit is over there, is able to provide diversification benefits to the lender. So looking at its credit profile, it has a stable funding base and good access to capital markets. We think it has a healthy liquidity profile with high quality liquid assets representing about 17% of the balance sheet. So at the end of September, this generally covers the short-term requirements of the banks, and including their long-term maturing debt. So within, they have a perpetual note within the Sing dollar space. So this is the 6.125 note. It's actually callable and resettable on 16 April 2024, meaning that the issuer can call back the note in April 2024. And if it doesn't call, the distribution rate will reset to the prevailing 5-year swap offer rate plus 1.207%. So if you look at the yield right now, it's about 5%. So I think it's pretty okay for a Sing dollar name. In fact, the yields have been going up recently due to the recent weakness. So I think it's attractive, yeah, at this point. With that, I will pass on to Jason, who will talk about his bond idea.
Thank you, Dexter, for sharing. So I select the China water affairs for you guys as a pitch. So this company actually provides water supply, sewage treatment, drainage operation and construction, as well as related value-added services in China. So actually, China Water Affairs has its competitive advantages over its peers in terms of segment breakdowns and also operating strategies. So first of all, in terms of segment breakdown, about 80% of the company's revenue are generated from the city water supply segment, which has stronger cash flow compared to its peers. In terms of operating strategies, the company has actually operating a business model called TOO, transfer, own, operate, rather than BOT, build, operate, transfer. So for TOO, which the companies has applied, the company can have the franchise for the water utility assets for over 13 years, which is quite a long period. And after the expiration, the company can extend this franchise. In other words, the company have the perpetual right to use the water utility assets. Conversely, other peers who operate through BOT has to transfer their project ownership after expiration to the regional government without any compensation. Besides, the company at China Water Affairs will actually regularly acquire new projects. These newly acquired projects will generate stable cash flow to the company in the next few years. So these provide a lot of deleveraging opportunity for the group. And also the group can lower the debt level by acquiring lesser new projects. Next slide, please. So here is some key financials for the group. And in the first half of 2022, the financial year, the group's total revenue increased 26% year over year to Hong Kong dollar 6.5 billion. And the operating cash flow margin increased from 22.6% to 26%. And the revenue growth and the cash flows are quite decent in both cases. And also the company has a high operating cash flow margin of over 25%, as mentioned. Conversely, the peers who mainly engage in sewage treatment usually have negative operating cash flows and highly leveraged. On the other hand, the company's current net gearing ratio was decreased to 78%. The higher gearing ratio is due to the acquisition of its new projects through debt financing, together with the increasing size. As mentioned, given that there are existing deleveraging opportunities and also the competitive advantages about the TOO models over peers, accordingly, we believe that overall for this company, its credit risks are still under control. Next slide, please. So here we sum up some numbers for the China Water Affairs bond. We select the bond due on May 2026 for investors who want a decent yield with the current yield to maturity of 5.6%. And the issuer credit rating is BB+ from S&P, considering as the highest grade amongst long investment grade level. So to sum up, given its resilient business model, strong cash flow generators, decent revenue growth, as well as less sensitivity to economic cycles, this bond is quite attractive. The bond is available on our bond access platform, so investors can get into this bond with a lower cost. Here's come to my part. I will pass to Teng Chong to talk about his bond idea.
Thanks, Jason. So one of the sector we are keen on is industrial REITs. And according to a report by Google, Temasek, and Bain, e-commerce in Singapore is expected to grow at a CAGR of 16% from 2021 to 2025. And the pandemic has brought about many new users to e-commerce as COVID-related lockdowns prevented people from doing their shopping in malls. And we think that e-commerce will continue to grow and be resilient during pandemic-related lockdowns or restrictions. Additionally, adjusting to the new normal where potential new variants will continue to impact our economy and unexpected lockdowns to occur, e-commerce will be largely unaffected as these businesses do not require physical stores to do their daily operations. Therefore, with all that said, we think that demand for warehouse and logistics spaces will be fueled mainly by the growth of e-commerce, and therefore providing industrial REITs with rental and cash flow stability as their operations will not be largely impacted by the pandemic. And one of the issuers that we are keen on is AIM's APAC REIT, and we think that AIM's AA REIT will be able to capture this growth and demand for e-commerce as tenants look for spaces to expand or set up operations in Singapore. 36% of AA REIT's current tenants are from the logistics industry. And within its property portfolio, 50.2% of its properties are logistics and warehouse spaces. And AA REIT's liquidity has improved with cash increasing to 108 million from the issuance of their 5.375% perps. And additionally, the REIT also has access to additional available undrawn committed facilities of 151.8 million, which is more than enough to repay its fixed rate notes, which are due in March 2022. The REIT has also obtained commitments of 220 million Sing dollars and 100 million Australian dollars to refinance several of its secured debt facilities, which are due in 2021 and 2022. And after refinancing, AA REIT has only the 2022 fixed rate notes to repay this year. And now from the available bonds issued by AA REIT, the AA REIT 5.375% perps looks the most attractive, providing a indicative yield to worst of 4.88%. And they provide a 38 basis points step up from their 5.65% perps for a difference of about 1 year in their call dates. And we think that with its recent acquisitions and early refinancing of its expiring debt in FY22 and FY23, the management for the REIT has taken proactive steps to manage capital well within the REIT. And along with its acquisitions and warehouse and logistics properties, we think that the REIT is underpinned by e-commerce, which we think it will be a resilient industry during the pandemic. And with its stable rental income and cash flows, we think that the 5.375% perps will be able to provide stable and reliable cash flows to its investors for the next few years. Now, with that, I wrap up our bond picks, and I'll pass my time back to Sarah.
Thank you, Teng Chong, and thank you all of our analysts. So I think on our next slide, you'll find a summary of our fixed income analyst bond picks. So you can go ahead, take a screenshot or take a picture. Basically, do whatever you need to do in order to be able to go and read up more about the bond if you wish. Our analysts have actually written, they have actually covered these credits on bondsupermart.com. So actually, if you wish, you can go to our website and have a look at the articles there. Okay. And now, right before we move into our Q&A, we'd like to share with you about some of the other ways you can actually connect with us at Bond Supermart. You can search for Bond Supermart on Telegram, Facebook, and Twitter. These platforms are where we will basically post new bond issues, credit updates, and insights, and it's where you will get first-hand news on our thoughts and our ideas. You can also check out our podcast It's called Yield Hunters, and it's available on your big podcast platforms. So basically your Spotify, your Apple Podcasts, your Google Podcasts, and more.